Welcome to webinar number 48. And today we're going to discuss is the AI bubble bursting and what does it mean for us if we are invested. So this started a few weeks ago when the Nasdaq started to show some downward trend, down about 12-15% over a few weeks. But since rebounded a little bit and trading sideways, but what we wanted to really understand today is, does it mean that the bubble is coming to an end? And what can we do to protect ourselves and our portfolio during such uncertain times? So this reminds me of the dot-com bubble. At the time, I was still in secondary school, I think. Yeah. And there was a scare on the 2000 buck, right? And but what I remember is there's so many more websites coming online and so many interesting things to explore on the internet. This was one when I was first getting started to know about the internet and exploring the internet. But at the same time, the stock market was going crazy, and so much so that many dot-com companies without any revenue, they are promoting themselves very aggressively, and these are just some of the dot-com Super Bowl ads. Pets.com, of course, the poster child of the dot-com bubble. And we're gonna discuss a little bit more about what are some of the similarities and also what are some of the key things that we could learn from past bubble all the way to from hundreds 100 years ago. So we're gonna give a few example, but do note that today the presentation is something that is created by myself, and I right now is a wealth advisor with iFast Global Market, but all the information here is presented by myself and my own opinion. So this would not be representative of the stance of my employer. And do note that please take this information just as educational content and for your information and not investment advice. So this is part of a bi-weekly webinar that I do. And if you feel that you can benefit from it, you can of course make sure that you are on the invitation list, because I do not post this publicly on the web. Only for those inside the invitation list. So make sure that you're on it. You can sign up for it on learnwithstanley.com. And if you feel that there are other people, your friends or family, that might benefit from this ongoing webinar content, you can also point them to my website as well. So for myself, I have been sharing content for close to 10 years now online. And it started with my previous job as an analyst, talking about investing on the online space. And it brought me to inspired me to write a book with my co-author called Value Investing in Asia. And from there, we have launched our online content since then. So right now, I work for iFast Global Market, as you guys know, and iFast is basically just a wealth platform that allows you to manage your investment all at once. And my key role there as an advisor is to help clients to go through their finances in a much more detailed manner. And with the help of my software, I try to make sure to iron out the key financial goals that my clients is working at towards, and how we can plan out a systematic investment plan for them so that they have a higher chance of success in their financial journey. So if that's something that you want to have a discussion with me one-on-one, you can also reach out to me from my website, learnwithstanley.com. There will be a link for you to reach out to me. Okay, I'll not touch on this one, but today we're gonna discuss a few things. Mainly, let's look at past bubble, the two of them, the dot-com bubble and then the railway bubble, and how this story is similar in so many ways with what we are experiencing now with the AI bubble. But what can we also learn from these past experiences and how to prepare ourselves maybe for the future in the safest possible way? So the year is 2000, and you can see that this is a chart of Nasdaq and S&P 500, and you can see the amount of rally that Nasdaq has seen since over the past 10 years, from the 90s all the way to the 2000s. Nasdaq basically went up 1000%, which is 10 times. But within a short period of time, 1 or 2 years, it has collapsed close to 80% within that short span of time. And it took Nasdaq 16 years to recover the losses. So crisis and bubble can be a scary thing, and it could lead to permanent loss of capital if we are not careful. So the story really started out in 1990s, where the World Wide Web is born, and from there, the internet is created from the campus of the US, and from there, it really sponged a lot of interest into what this new medium could possibly do. And one of the first key iconic moment that the internet become more than just for the military or for university and give access to the public is through the Mosaic web browser in 1993, where it was created. And from there, it basically opens a window for anyone with a browser to reach the rest of the world. It took another year when when the founder, one of the founder, the leader of the team that created Mosaic, left the university and started a company by himself, but started a company with his partner, so Mark Andreessen and Horowitz, and they created this company and the browser called Netscape Navigator. And at the time when it was created, only in 1995, only 0.7% of the world is on the internet, and they, with the Netscape Navigator, is a key driver of changing that landscape. And now everybody, with by buying a license for Netscape Navigator, we can go online. So this is basically the timeline. You can see that it happens quite within a very, very short period of time, and the excitement about Netscape really rise within a year of the founding. Right, the company was founded in April 1994. It was first named as Mosaic Communication, but then it was changed to Netscape Navigator when the browser became a success in March 1995, so within a year. But once the Netscape Navigator is launched and released and started to sell to the public, within 8 months, the company IPO'd. And the IPO of Netscape is a key moment that marks the start of the stock bubble, of the dot-com bubble. And basically the stock went from 28, right? It was oversubscribed, and it surged more than 100%, right? During the day, it surged close to a 200%, but then it closes at more than 100% in a single day. And some of the things that happen after that, it shows that the new dot-com era has begun, and the new idea can be extremely profitable, at least for the creators. And that's Netscape. They are analysts. These are some of the analysts and the industry people quotation, right? You don't need profit, you only need potential, right? Revenue no longer matters, and eyeballs and clicks and website traffic become the new currency. And when analysts is valuing a .com company, it's not so much of how much is the P of the company, what's the revenue of the company, but rather what's the website traffic, how much click and eyeballs that the new product is able to attract. And this also was ballooned with the flow of venture capital money flooding into Silicon Valley. So when there's a gold rush, everybody rush into it, and it becomes the new economy, right? Everything get multiplied in magnitudes, and the dream just become bigger and bigger until the point where people feel that everything will be disrupted, everything will move online, bricks and mortar are dead. We have to invest now or be left behind. You can see that almost every year there is bigger and bigger deals and more exciting companies being put into the market. With Netscape in 1995, Yahoo in 1996, Amazon IPO in 1997, each raising record numbers for its time. The next come after the IPO, next come many mergers and acquisition. Many companies started merging together with record deals, and I would say the most iconic one would be the AOL and Time Warner merger, 165 billion merger, unheard of its time, but also it marks the peak of the bubble in the end of 2000. So very, very interesting all the way. But how did the bubble actually pop? What really happens? Because everybody is still very excited about the .com. There are a few success cases that .com companies are really profitable at the time. Of course, Yahoo and Amazon is starting to show that it is the concept really works. But one of the key things is that the U.S. Federal Reserve started raising interest rate near the end of 1999 and early 2000 to combat the ultimate foe of the Federal Reserve, inflation. And that slowed down the flow of easy money when borrowing become more and more expensive just by a little bit. Because when everybody get too excited, the moat and the rationale is that I need to get as much money I have from my own pocket and also from other people's pocket by leveraging up, because this will never go wrong. And when the interest rate started increasing, borrowing become more and more expensive, and people started having money crunch and margin calls. The AOL Time Warner merger was really the ultimate symbol. When it was announced at the beginning of the year in 2000, the market was still euphoric, but by the time it went through SEC and went through the to clear for monopoly and other antitrust issue, by the end of 2000, Nasdaq has already fallen 50% by that time, before the deal even closed. So, other interesting thing that happened was that some of the companies that were showing high growth started to slow and miss their growth target. And when valuation becomes very, very high, a little bit of miss expectation could balloon into panic within the investors. We see it as well right now in a few instances, maybe not in a smaller scale, but I would say that it's starting to show itself in some instances. And then when some of these companies, they are running on the perpetual optimism of the market. And so when the market turns, they are not able to raise more money from the market. And this leads to some high flying .com bankruptcy. It really took about 2 years for Nasdaq to reach a bottom. So at the mid of 2000, it took another 2 years for Nasdaq to collapse and reach from what we know as a bottom, losing about 80% from its peak. So it means that basically when it comes to bear market, it will take some time as well, right? Although I feel that right now, uh, in today's age where information travels so fast and groupthink become more prevalent from social media, what we see that market crashes can indeed happen much, much faster and within a much shorter period of time. This story is not new, and it has happened again and again and again throughout the history of time, even before the creation of the stock market. Right? It happens in the railway boom. It happened in telegraph. It happens in China over the solar boom. Happens with the electric vehicles, and we see the collapse of it right now, slowly. And so this story is basically the same template repeating itself over and over again. Similarly, like a Korean drama, the same template, changing the characters, but the same old story has repeated multiple times. And I feel that one of the most interesting examples so far that I read that might be relevant to what we're going to discuss later is the rise of the railway uh, mania as well. So the year is early 1800s, right? 200 years ago. Transportation at the time was very, very slow and expensive. They're still using horses and canal ships, but both are very slow and there's limitation, right? But in 1825, there came a breakthrough where the first public railway in England is started, engine using steam locomotive, and a company is formed called the Stockton and Darlington Railway is open, and it was an iconic event, an iconic technological shift, and people line up just to watch the train move. Right, it felt like magic. It becomes an important milestone for the technological advancement of the human race. And within the next few years, it is proof that it is viable, right? Railway as a mode of transport can be successful. And the next few years, more and more railway companies started launching. It convinced that the public and also investors and also business people and even governments and even the even the Queen, I might add, that railway will reshape society and it can never go wrong. So much so that banks are encouraged to give loans to investors to invest in railway stocks because railway will never lose. Railway will never fail. Sound familiar? And one key characters that was born during this period, right? He really make his name during this period. One of the most interesting character of this era, I would say, is George Hudson. His nickname is the Railway King, and he was basically born pretty poor in Yorkshire in 1800s. No education, uh, no real skills, but a highly ambitious person nonetheless. And luck have it that just at the start of the railway mania, he got an inheritance of about £30,000. And in today's money, it is basically around £1 million today. And what he did with the inheritance is that he invests all of it and maybe with leverage as well, aggressively into railway stocks. And just right at the start of the railway boom. So he made so much money and reinvested and invested and become a kingpin within the rail industry that at his peak, he controlled about one third of all railway companies, right? He is instrumental in the merger of many companies. He was a director of dozens of them, and he became a very, very influential person within the British business and also politics realm. 1845, he successfully became a British MP as well. But you guys know how the story ends, right? Even before I finish the story, the railway mania, the real run up of the stock happens at the end, near the end of the its peak from 1843 to 1845, about 2 years, right? You see a huge jump up.
Hello.
Sorry, let me see if I can control some of their. All right, okay, let me get back. Okay, as I was saying, the mania took about 2 years to reach its peak, and it was a true technological breakthrough. And there was like close to 1,000 railway companies for you to choose from to invest. Railway stocks, their market cap made up half of the entire UK stock value, right? So as I'm saying all these stories, I want you to relate back to what's happening in AI, what's happening to the tech sector, uh, and you will see a lot of similarity, right? There are railways that are planned that goes to nowhere, right? They plan a route all the way to a cliff and sell the idea, and there are duplicate tracks all across England where different company lays the same route to compete with each other, and companies started raising money not with concrete plans or land rights that they have already gotten or deals that they have already secured, but just with a map and a story, and they can raise money from the stock market. Of course, all this came crashing down, and it also took roughly about 2 years for the crash to completely decimate. And again, one of the key factor of the turning point is that the government start raising interest rate because inflation started setting in when everybody is making money and everybody feels rich. When everybody feels rich, what happened? Everybody want to spend. Everybody want to do bigger deals. And inflation and construction costs all skyrocketed. And to combat that, government has to raise interest rate. And when interest rate increase, we started to see the same story again, railway bankruptcy. And George Hudson himself was actually end up being caught with fraud because it was caught later that he has manipulated accounts of different of his company so that he can continue this role, and his fraud was actually the first recorded accounting scandal in financial history. So that's a little interesting trivial. Of course, by the end of the crash, he was bankrupt, and according to according to Wikipedia, he spent his whole life just trying to repay the debt and fighting lawsuits that was passed against him. So I tell you these two stories that happens 200 years apart because I wanted to highlight just how similar this story, these two story really is. There was a point where investors started to get ahead of themselves, a little bit of irrational exuberance, where investors will pump money into just any new ideas that has the .com in it, has a line drawn on a map with it, and valuation becomes murky. And there are new ways to value companies, not with earnings and income, and they'll come up with interesting matrix to justify why the valuation is growing up. And more people who have never invested before, would start to feel that they must join in and invested. Interestingly, during the railway mania, people like Charles Darwin uh, actually was one of the investors that was caught up as well. So even very, very some of the smartest person, some of the smartest people during that generation cannot fight over the fear of missing out. And with this huge uh, participation and this huge interest in the industry, it's inevitable that what will happen is oversupply, right? Where everybody jump into the business and trying to dig for gold, there will be an oversupply and there will be duplication. And of course, people with less than people with borderline integrity will definitely rush into this space as well. But these two story, to me at least, also highlights that uh, financial bubble itself is not really the problem because the world is made up of humans, and we as emotional creatures would always fall for these stories. And in a capitalistic world, I actually think that financial bubble are necessary evil for a normal operating and for the good health of the long-term health of a capitalistic economy. Because because of this financial bubble and because of this excess of investment into the railway or through the internet, it really helped boost the infrastructure build up, and it really hastened and increased the infrastructure build up of this economy and shorten maybe their real development by decades. If there was no financial bubble to encourage the illogical spending into the infrastructure build up, then maybe the internet could take 20, 30, 40 years to fully build up, right? But instead, within a few years, the main infrastructure for the internet has been laid out. And the dot com bubble really forms the foundation of the next internet revolution with the rise of Google, with the rise of the tech companies, and made US the super empire of our days. And the same way, the railway mania, because of all the infrastructure built up during that short period of time, the railway formed the foundation of the industrial revolution and made Britain the super empire of that era. And both countries dominated global economy and politics for many, many decades after that. And that is the aftermath of an illogical financial bubble fueled by speculators and investors who do not want to miss out on the next big thing. So the cycle of a bubble tends to stay the same, but it always starts by a real tangible technology that has real benefit, be it AI, be it blockchain, be it EVs or .com or railways or telephones. This new discovery of this technology has real tangible benefits for humanity. And the early success of these companies kind of show us, everyone, that it is possible. This change is possible. This disruption is possible. But when we get too excited, it leads to unrealistic expectation. So that fuels the speculation. And when the bubble bursts is when capital run out, when there's a tightening. And we see in both examples just now, a key part of why funding tighten is because of rising interest rate. And the reason for rising interest rate is because of rising inflation. But at the end, the bubble will leave behind strong infrastructure and companies with true business model that can sustain for a long period of time. Companies like Amazon, companies like Microsoft, companies like Google in the last financial bubble. Today, they are magnitude bigger than what they were uh, during the dot-com bubble. But one thing I wanted to highlight to you guys is where are we now, right? Of all the deep memories of the dot-com bubble and how drastic it is, where it took 16 years for Nasdaq to recover from 2000 to 2016 before it reaches the top again. The S&P 500 took about 13 years before it reaches back to the peak of 2000. But of all this horror story that we hear about 2000s, uh, this is where we're at now. About five times more than where the dot-com bubbles were, right? That doesn't mean that we are at the peak of the bubble or anything, but what you see, especially when you overlay, say the Bitcoin prices, you can see that bubble comes and the next bubble typically becomes bigger and bigger and bigger over time. If there's real tangible improvement in the technology. So some of the key factors of past crashes that I think we should remind ourselves and learn from is that as the bubble progresses, more and more investors would gain in confidence and feel that they should go into levered products and levered and borrowing money because they see it as a sure thing. And with rising stock prices or asset prices, it typically leads to high inflation over time, and the government tends to want to fight that no matter what by raising interest rate. And once the interest rate is raised to a point where it hindered the growth, and as growth slow, not even when the growth stops, but just when the growth slows, many investors could end up panicking, and it could have a cascading effect when one investor is caught with a margin call and everybody rush for the door. And in this event, when the market collapse, in other words, we call it a credit unwinding, where those who are playing with money that they don't have end up getting squeezed out of the market. And another interesting observation is that we will tend to see that Berkshire Hathaway, the company of Warren Buffett, tends to underperform during this period, during the boom cycle. People will call investing dead. People will call that value investing is old school and doesn't apply to the new world. And you can see how Berkshire has underperformed the broad market over the last few years as well. These two group of people has very different outcome in life. George Hudson died as a bankruptcy and as a fraud. Mark Andreessen and his partner Horwitz, they successfully sell Netscape in 1998, I think. So they got off before the bubble burst, and with that money, they also started another new company, and has enough funding to last them through the dot-com crash. And today, two of them are some of the most prominent venture capitalists in the Silicon Valley, and still deemed as uh, saint level in the tech space. But I can't help to notice that could luck have played a different role, right? Are they just lucky, and maybe George Hudson is a little bit unlucky? What would happen if George Hudson was able to sell out before the crash, and no one really discover the fraud that he committed during the crisis, right? I'm not saying that. I'm not uh, comparing the two groups as they are the same, but I'm just saying that both are the results of the bubble, and things get turned out very, very differently for everyone. So, but in investing, for us, especially if we're not in the industry and we're retail investors, the worst thing that we want is to rely on luck in the stock market, because we can be lucky once or twice, but it's very, very hard to grow your wealth for a lifetime based on luck. In a way, these two groups of people, they are what we call the anomalies, right? And we shouldn't plan our life hoping that we become anomalies. So, what can we do if we're investing in the market? If we still want to invest in the market, because in the long run, the market still would tend to reward the patience investor. Some of the key things that I feel that we can do is that we should always prepare ourselves mentally that nothing lasts forever. A market cycle will always end, and the stock market cannot go up all the time. But we will never know exactly which point will the market start to turn. And we would not want to base our investment strategy on timing and guessing when the market turns, because that in itself is a losing game. But a key way for us to protect ourselves to make sure that even if it happens, we can survive. We can be there for the next bull run. Similarly to what happened to Mark Andreessen and his partner, that yes, they got lucky by selling it out in the first round, but they also is prudent that once they have that wealth, they make sure that they manage it properly and didn't lose it the second time when the market crashed. So don't leverage, I would say that is the most important thing for us to remember in investing. I I try to advocate that we should never use leverage at all times, but especially when we feel that the market is in a bubble and is in an up cycle, that is the point where we should not use leverage at all. And we should try not to chase after returns, not going after companies just because that they have the highest jump, just because they are the hottest stock right now, but rather focus on higher quality business and higher quality business at a good valuation. Basically, my philosophy is the higher the market goes, the stricter that we have to become as an investor. So when you feel that during a market crash, if we can control our emotion, not get panic ourselves, right? It doesn't really matter what we buy, because most things will go up in after a market crash. But if the market has been going up for a long period of time, like now, we have to become stricter and stricter in our criteria when choosing what to invest. And we have to ensure that we don't leverage and we have strong financial strength to last through the winter when it comes. Bear in mind, some of the stock market crash over the last 100 years, they can last 2 or 3 years. if you really buy the dot-com bubble at the peak, right, it could last 16 years. But typically nobody would buy all in the one point, so the cost is averaged out. And in investing, the key here is really not to win the game. When I look at investing as a game, the objective of playing in the market is actually not to win, but the key is to make sure that we last the longest in this game. And if we have that concept and we start out investing using that mindset, then you will realize that protecting our own financial strength and our financial balance sheet is the most important when it comes to investing in the market. And one interesting observation that I wanted to share with you guys throughout this different stock bubble and over investing for the last 20 years is that I realized that the market tends to favor um, different modes of investing style over different period, meaning that there are periods where one investing style tends to work better than the other. And broadly speaking, in fundamental investing, uh, in the stock market, there are two basic groups of investing style. One is growth investing, which is G, and the other is value investing. So what's the difference? Is I would classify it as growth investing puts higher emphasis on the growth potential of a company, whereas value investing put higher emphasis on the valuation and price that you buy at of the company. Both you can invest in companies that are growing. You can invest in companies that are doing exceptionally well. But during growth investing, sometimes the valuation of a company takes a secondary stage and it becomes not that important in the market. And we definitely seen that over a period of time. And in the last 16, 17 years that I've been investing, I have seen how this different style comes and goes and become flavored by the market, one over the other over a period of time. And I wanted to highlight that this is my own interpretation, but you can see that they tend to switch around. So there are periods after the global financial crisis where value investing actually does pretty well. Um, but when the market got comfortable with investing, valuation becomes stretched because at the beginning, valuation is very cheap, but you will reach a point where it becomes borderline uncomfortable for a true value investor to invest aggressively. But the market continues to go. That's when people become more and more focused about what is the growth of the companies or the growth of the economy rather than what's the valuation, which is why we see the valuation of S&P stretch out quite drastically. And when the market start to turn and become a bear market, that's where value investing comes in vogue again. So right now, clearly that most people is focused on growth and most people are not focusing so much on Warren Buffett and what he's doing. But I would say that most likely when the tide turns, people will start to see him as an oracle again. So why not uh, why not shift our own investment more towards that style and prepare ourselves, right? Again, I'm not saying that the market could come down or go up in the next few years. I really don't know. I'm still invested myself, and I'm still invested for my client as well. it comes down again that I try to remind them that only at a situation where you can ensure that your financials is stable, right? You don't really need this money for the next few years, then we can be comfortable investing throughout different market cycles. Because to reach maybe our financial goals in the next 10, 20, 15 years, there is still time, even if we met the crash today, for the market to recover, especially again when we focus on higher quality assets at a valuation that we can be comfortable in to invest. It takes time to be comfortable at being uncomfortable in the market. But I think one of the key things that have helped me and my clients is that you have to understand how the market performs over a short period of time. It really is not that important in the grand scheme of things. Because at the end of the day, what we want is to reach our financial goal, be it planning for retirement, planning for your kids, planning to buy a house. There is a target that you want to reach. And in order to reach that target, the input has to be as good as the output, right? The output we cannot control year by year what's happening, but we know that if we invest in strong fundamentals funds or companies and uh, be safe in our investment, it typically will do well over a long period of time. But then the input has to be consistent as well. So if we want to save up $1 million, how much do we need to save up per month? If you save about $2,000 a month, in 20 years, that's about $500,000 without doing anything. You can just keep it in the bank. But if we put it into investment as well, that could give maybe 6%. That 500,000 become a 900,000 in the same period, right? If you can boost that by 1%, by 2%, how are we going to do that? That's where I come in. But that's also a way to ensure that we have a higher chance of reaching our financial goals. That we have to be consistent and be mindful that what we are saving up for. This is a little bit tricky to read chart, but I do want to spend some time to explain it to you because I wanted to showcase to you guys that the blue bars are the S&P 500 tracking over the past 10 years. You can see the market go up and the market go down. But what is interesting is um, if we are able to really consistently save and invest over the long period of time and be disciplined about it, right? Either if you are disciplined by yourself, that you can manage it for 10 years by yourself, all the power to you. Or if you work with someone like me as a wealth advisor to make sure that you keep the target in mind and save in a consistent manner, you can see that the blue line is your cost. Over time, you grow, but the brown line is your asset value. So at the beginning, in the first 1 or 2 years, regardless of the market going up or down, you'll realize that in the grand scheme of things, it doesn't make that much of a difference. So you can see that after we invest right at the month 3 and 4, market started crashing. But if you're really consistent for 10 years, you can see that it's not even noticeable the gap between the value of the stock value at the time versus your cost. And what is interesting is if the longer that you invest over different market cycles, you'll realize that the value of the portfolio will compound higher and higher through different market ups and downs. This is after a crash. you can see that even after the crash, your value of your portfolio is still higher than your cost. So it's still better than not doing anything. And when it recovers, that's where you see that your portfolio can enjoy the true power of compounding and investment. And all this starts by having a plan. And all this starts by understanding your financial situation. And that's kind of the key work that I do with my customers and clients to help them understand their current status, their current cash flow situation, and work out whatever financial goals that they might have. How are they going to do it? And where are they going to be investing in to have the highest possible chance of reaching their financial goals and putting their financials planning uh, to have a better peace of mind throughout. Right. So if you have any question about what we discussed today on understanding the current situation, or you have any interesting thoughts that you want to share with us, I hope you would pull up your chat box and let us know. And again, I want to focus a bit more that at the end of the day, the the actual investing in the particular stocks or be it funds or ETF, one or two individual investment is not so important. And in fact, what is more important is understanding your exposure and your allocation from your entire asset viewpoint. And if you work that out, what you are exposed to, and if you have a diversified exposure, you have a higher chance of protecting your wealth for the long term. This is a screenshot from our iFast platform of how, say, you're building a ETF portfolio could look like. And bear in mind that I'm a big believer of cost control and cost structure. And which is because when I find an investment, be it a fund or ETF, uh, a 1 or 2% difference in costs over the long term could balloon to a sizable amount if we're investing for a long period of time. So because of my work, I tend to work with clients who have longer viewpoint and longer time frame when it comes to building up their wealth. And the key to that is to really protect your compounding effect for that few decades. And if you're able to maintain the costs and not disturb the power of compounding, that saving and that consistency could balloon to a very, very sizable amount for for you. So if you again want to have a chat with me one on one, do reach out to me on learnwithstanley.com, and there is a form for you to reach out to me, and I'll definitely be very excited to learn some of the things that you have been going through and seeing where in the picture that I can help you reach your financial goals. Okay. I'm Stanley, and I'm from iFast Global Markets in the Johor Bahru branch. Uh, if you just want to connect with me on social media, I'm most active within LinkedIn, Facebook, or YouTube. You can search for me, or you can find the link, actual link, again on my website, learnwithstanley.com. So before we go today, if you have any question, I do want to hear them. While you're typing that out, wanted to share with you guys my spin-off segment where I just share with you guys interesting things that I saw. This has been a while, but I think it's still relevant to showcase to you guys. If you enjoy motorsports, maybe you have heard of this guy called Marc Marquez. But if you've not, he's basically the legend in MotoGP, motorcycle racing, and he's one of the greats. What happened is he recently re-won and became a champion in MotoGP after a five year 5 year drought, and that's because during COVID period he had a very drastic crash which broke his arm and collarbone and his entire right arm, and it took him a few years of recovery. And after he got recovered, uh, and come back to racing again, within a few races, he crashed again and broke more bones within his body. And the whole ups and downs of his recovery took about 4 or 5 years. And and during that period, his team used to be a championship winning team, dropped to the bottom and become at the bottom of the table. And he has to, while recovering from his injury, negotiate and navigate his way to different teams uh, to find a championship right again. And it come full circle where he did a full comeback, and it's a great story. It's a full documentary about that period of his time on YouTube. Uh, it's really inspiring, and it really showcases how athletes at the top of their game really never gives up and could live is ready to give their life for the sports that they love. So it's just a inspiring video and interesting thing that I wanted to share with you guys. So with that, I always end with a quote, and the quote for today is that you will never know how strong you are until being strong is the only choice that you have, by Bob Marlin. With the sharing of Marc Marquez, I thought I end with such a quote. Thank you so much for your time this week, and I hope that you have a wonderful investing journey ahead. And if you have stories to tell me, I hope you do reach out to me and let me know. Till we meet again, thank you so much for your time. My name is Stanley. Invest safely, guys.